bring in Shane Obata for his take on the markets. Welcome to the show. It's great to have you here.
Thanks for
having me. I read your notes on the current markets, and you are not as bothered by the narrow breadth that everybody has been bothered about, it seems, during the first half of the year. And that's those, whatever you want to call them, the Magnificent Seven, those mega cap tech stocks are being responsible for really all the gains on the S&P 500. Why are you not unconcerned?
It's, you know what, it's hard not to be concerned in the market. I will say that every day you're kind of fighting to stay positive. So I wouldn't say I'm fully 100% bullish. There's things that I'm worried about. I'll talk about interest rates and inflation in a little bit, but if you look at the history of the stock market, the outsized gains have come from a small subset of companies. It's not totally out of normal, for example. So that's kind of the beauty of investing, is you could have an investment that goes down 100%, but if you're a long-only investor, you're only buying, you could have something that goes up 10,000% over time. So hopefully you can find some of those in your lifetime, and it makes a big difference. But that's the longer-term study, and then maybe a shorter-term study. There's some good research from Goldman Sachs that showed that the top 10 stocks make up about 32% of the S&P 500's gains in the median year since 1995, I think. So leadership, of course, we want, our firm wants breadth to expand. We want to see that in the second half, but we're not necessarily scared by the narrow leadership.
Does it make sense that the tech stocks have rallied so much while central banks, most notably the Fed, have continued to remove liquidity from the marketplace by raising interest rates? That was the huge concern in the latter portion of 2022 when they came down in a big way.
It's also a reversal of last year, right? Saw the most outsized pain. I think really more than ever now, the market is so highly dependent on interest rates. All markets are really dependent on interest rates, right? And so we went through this period of worrying about rates and inflation, and we're now getting past that. There's still work to do, but we're getting past that. So if we think about tech as a longer duration asset, meaning that a lot of the value of an equity of a tech company could be in the outer years, basically. So that's why those stocks performed the worst when inflation was the biggest problem, and now they're rebounding. So that's a long-winded way of getting back around, but part of it is a rebound, and then part of it is kind of a return to the idea that they can lead in growth also. So it's interesting, there was a period in time where if we looked at, I can't remember the exact moment, but historically you had the FANG stocks, or whatever you want to call them, generating much better than the market in terms of sales growth and earnings growth for a long period of time. And that's why they commanded a premium. That's why they were so sought after. There was a period of time coming out of COVID where that was no longer the case. But now we're coming back to the same thing, where expectations have ratcheted up. We could see earnings, sales growth, for example, 2-3 times higher than the market over the next few years. So I do think there's fundamental underpinnings here. Sure, some of the year-to-date gains have been pretty amazing, but it's not all fluff.